Thank you, Ellen. Thank you, the organizer, for having us. So it's the first session after lunch. I don't know about you. Usually after lunch, I tend to be kind of lower in the way I move, in the way I talk. So I'll try to keep this entertaining a little bit so that we don't lull into a little bit of complacency about this, what I'm doing, especially. So this is joint work together with several co-authors, with Feng Chang at Fudan University, Lucy at ACB, she was former at the fund, Federico Greenberg was discussing the paper before, and Brandon also at the fund. And of course, the usual disclaimer applies. These are only our views and not the views of the IMF board on its management. So this is the first famous about the infamous CBDC. I mean, Governor Worrell said before, why CBDC? Is this a problem looking for a solution? Well, here, we're going to take a different stance. We're going to say, well, it's going to exist. We're going to sidestep that problem. It's going to exist. If it exists, what are the consequences for the financial system? You know, and we also heard before from Sir John Califf, different central banks have different views about the objective of CBDC. Some say that maybe it doesn't really have a problem. Some say, well, no, it can bring efficiency. I mean, the views of the Bank of England with the Treasury is about having a platform for the private sector to innovate, and maybe something to have a monetary anchor for the financial system. So in general, we can think they can accomplish more efficient, secure, modern central bank money and get away from the digital money. At the same time, one of the key concerns, the first one that were raised whenever we discussed about CBDC was about disintermediation of banks. And in this paper, I'm going to mean by disintermediation the decrease, the outflow of deposits from the banking system because of CBDC. So that's going to be the definition of disintermediation within this paper. And given this, well, how this will affect bank lending decision, especially because that's what we care for a lot in our discussion, the provision of credit to the economy, one of the fundamental functions of banks. So what we're going to do today is use a standard portfolio choice model with banks, and we're going to try to analyze disintermediation of banks when CBDC is introduced. Now, in order to already provide the findings, we're going to have a first basic toy model with homogeneous agents. And these homogeneous agents are going to have very simple CS preferences, and they're going to hold the liquid assets, and they're going to have banks with market power. So in this very simple setup, once we introduce CBDC, there's actually no disintermediation. There's actually an increase in deposit in the banking systems. Why? Because banks react, and react by increasing remuneration of deposits. And that's actually enough in order to, for households to actually have more deposit in the banking system. If this is only the story, then it's kind of disappointing. It's like, okay, where are the problems? And so then we have reached the model. And we have reached the model along two key dimensions. The first one is we introduce fixed costs of holding CBDC and deposits. And this plays a huge role in the model and the results. And then we're also going to introduce some heterogeneity. And it's going to be also important. And what happens is that now we're going to have an extensive margin. People are going to choose whether to hold CBDC or not, or to hold deposits or not. And once you start introducing extensive margin, well, the results can be overturned. And so you're going to have that, okay, there is always this competition to banks by CBDC, so bank deposits will fall. And total deposits actually may decrease, but only under special conditions. It's not a given. And in a further extension where we're trying to use also lending, the effect of lending is quantitatively small. And I'm going to try to explain why we get that. So, long list of papers in the literature. I'm not going to go through it. Some of the authors are here in this room. So, maybe some are not even here. They are in the paper, and apologies for that. But I mean, the literature on CBDC is starting and it's burgeoning now, especially on the financial, on the financial implication side. So what I'm going to do is basically I'm going to look at the basic Mickey Mouse version of the model, then the enriched model, and then talk about the extensions when there's also we enrich the balance sheet of the banks. So what is the overview here? So we're going to have portfolio choice model. households, they're going to invest and manage their liquidity needs. So there was this discussion this morning about liquidity. What one of the Scott was presenting about, okay, what is, how low should we go in terms of to model money? What are the key frictions? Here we're going to take actually a very high approach. The household is going to have notes, CBDC, and deposits, and they're going to have some illiquid bonds in which to invest. And we're going to assume that notes, cash, CBDC, and bonds are a fully elastic supply. The central bank can set the rate on bonds and set the rate on CBDC. But for all of our talk today, we're going to set the rate on CBDC to 0. So it's not going to really matter. So it has no interest rate CBDC. And then we're going to have banks, several banks. They're going to provide deposits and choose the remuneration. So banks, they act as competitive monopolists in deposits. They choose the deposit rate in order to maximize their profitability. And their profitability is basically, in the simple now model, the only thing they can invest into the bond, which is a return of F. So basically, the only margin is how much they remunerate or deposit, this RD, and how much they invest, and this is actually the only thing they care about. So the model is very much based on the paper by Drexler et al. On the deposit channel of monetary policy. You might be familiar with this paper, but it's taken out there. So going a little bit more into details. So what do they care, these homogeneous households? Well, they care about wealth, and they care about liquidity service. So remember I was saying before, you need to choose how deep you want to go into the frictions motivating you towards money. You might want to, money into the utility is a trick. It's a trick that is useful as long as it buys something else. You know, one of the first things that I learned when I was starting doing mathematics is that the blanket is always too short. If you pull it from one side, if something else leaves open. Here, in this side, we wanted to take a closer look at the heterogeneity of households in terms of wealth, because that's what we think is something interesting. And so we took a very high-level approach on this, on the money demand side. And so, well, the wealth, there is L, which is the liquidity services, and there is some complementarity between wealth and liquidity, and then we're going to have liquidity services given by cash, by deposit, and by CBDC, and there are substitutes among them. We're also going to assume, for the sake of the argument, that somehow that the delta C, what is the relative utility of CBDC with respect to deposit and cash, is going to be higher for CBDC with respect to deposits. And the idea here is that we're building something that is actually more convenient for payments with respect to deposits. And then, well, the budget constraint of this household, well, they can invest into the bond. The bond is going to give them the return F. And everything else they don't invest into the bond is going to cut into their return. So if they hold money, the opportunity cost of holding money is the opportunity cost of holding the bond. If they hold deposit, is the difference between the cost of the bond and the return on deposit, and the same for CBDC. But we forget about our C, it's going to be 0 anyway. So what is the nature of the exercise now we're going to do? We're going to compare the equilibrium of the model in which there is no CBDC, apologies. So we're going to set this delta C parameter equal to 0. And then we can compare the equilibrium when there is CBDC with this delta C greater than 0. So this is the nature of the exercise we do. And let me do the first result into this basic model. And this first result is actually, we can work it out analytically in a limited case in which we let the value of liquidity services go into 0. But still, it's insightful because it gives a first take of what are the forces at play that we are describing here. So here, in this simple model, whenever we introduce CBDC, deposits, so aggregate deposits, and their remuneration increase. Well, why? Because the competition from CBDC forces banks to increase the deposit remuneration. Banks, they want to have deposits. They have an investment opportunity at half. It's a pity for them not to have deposit because they can gain a profit. And so they say, okay, fine, I'm going to increase the remuneration of deposits so that the household don't substitute away from banks. It's kind of an analogy, it's like a monopolist losing market power, they charge less and supply more, and this is actually what is happening with banks. And the depositor actually increased their holding of deposit because, well, okay, now there is CBDC, I'm going to hold some of CBDC, but also when you hold more of deposit, why not? Well, because now the return on deposit is higher. And if you want, this is the intensive margin of your choice of how much deposit to hold. You're there. We are only looking at how much you're holding, given that you have to hold it. Now remuneration on deposit is higher. Great, I'm going to hold a little bit more. Okay, if this was the end of the story, then we're like, okay, what's so much to worry about? But then clearly here, what we're not looking at is the extensive margin. People are going to say, well, do I really want to hold a deposit if there is a CBDC? In order to do that, well, we need to enrich a little bit the model in order to look at these questions. So how we're going to do it? We're going to have heterogeneity in households, in wealth, and we're going to have their different initial wealth distributed as a Pareto. And then we're going to have households that face utility cost to access other deposits or CBDC. And something like, the cost, whenever we open a bank account, there are costs of you going to the bank, doing all the KYC requirements, taking the time, filling in the data, and so on. The same is going to be for CBDC. We think it's going to be actually lower. We might think we are designing CBDC in a way that should be easier, also for financial inclusion purposes, than having bank deposit. So we're going to assume that these costs are actually going to lower for CBDC than for deposits. Now, we went the way of utility cost. We also tried the way of pecuniary cost, putting into the budget constraint. It turns out that the math was easier this way, but there's no real, the result do not really hinge on the fact that where you put as utility cost or you put as pecuniary cost. It's just a convenience for us. And so now, well, if you want to use deposit, you need to incur a fixed cost. If you want to use CBDC, you need to incur a fixed cost. And this creates the extensive margin, something that, okay, fine, if we introduce CBDC, we can at some point think of people completely not holding it anymore, saying, okay, fine, for my liquidity purposes, I'm very well served by CBDC. Why hold the deposit account anymore? And so I'm just going to close it and get away with it. Now, this setup, even though it's still a simple model, but once you start introducing heterogeneity, fixed costs, and so on, then analytical solutions become very difficult to obtain. And so we're actually going to turn to numerical simulation. So what is an equilibrium here? The equilibrium we're looking at is, before you have CBDC, you're going to have a fraction of the population that only holds cash, and a fraction of the population that holds both cash and deposits, and depending on how willing they are in order to pay the fixed cost in order to access deposits. So usually the poorer are going to hold only cash, and then the richer part of the population is going to hold both cash and deposits. Then once you introduce CBDC, there can be several equilibria, but we focus on the one that we think is more empirically relevant, which is a segmentation of society in which the very poor are only going to hold cash. The middle class will hold cash and CBDC, and then we have the richer that are going to have cash, CBDC, and deposits. So let me go directly to the calibration. And sorry, this slide is slightly, the font is tiny, but it's the only one there. But just in order to point out a couple of things, because there are several parameters in the model. The first one is this lambda, which is the importance of liquid asset with respect to final wealth. And we choose this value to match the share of non-liquid assets into households' portfolio wealth, which is roughly 80% for the US. Then we have this other delta D, which is the liquidity usefulness of deposits relative to cash. We set this to 1.5 to match the share of wealth in cash versus deposit. So usually in the US, 11% of M2 is held in cash. So that's what we have. We have this FIDI, this fixed cost of accessing deposits, and we put it in such a way to calibrate 80% of a population that is fully banked, and we get this number for some FDIC publication. So the rest 20% are unbanked or underbanked. And so, but 20% are fully banked. And then we have a wealth distribution, and we're going to do this in order to match it, the Gini coefficient of the US, 0.49, so we have a shape of the parameter alpha, which is 1.52. And then there is another bunch of parameters. Some of them, we put it in a way that is sensible with the existing literature, given the equilibrium existing conditions that we have within the model. For instance, the one on row, complementarity, and sustainability, number of banks. We need to choose how many banks. Here we're going to put 8. seems like a reasonable number. These things are not, I mean, the results are not very sensible to J and so on. With some other ones, we're going to actually do, we do in the paper, I'm not going to talk here, but we're going to see robustness, how things change when we change the parameter. Importantly, what we're going to talk a lot about is how results change when we change the cost of accessing CBDC and how we change the wealth distribution in the economy. So what is going on in the model? Actually going very fast. I can go slower. So as I was saying, so here is a simple chart trying to show what's going to happen in the model before I get to the actual results. On the x-axis, we're going to have wealth of the individuals. And then this blue line is how much they hold of deposits relative to wealth. Given this is a CS model, they're going to have, each is going to hold the same share of their wealth in the instrument. So each is going to hold a fixed amount of wealth into deposit in this case. And then there's going to be a threshold. In this case, it's called WA. Below this threshold, well, nobody's all deposit. People will hold only cash. And then above this threshold, well, they're going to have around 20%, I guess, if these numbers are right. Around 20%, a little bit less in deposit of their wealth. Now, what happens when CBDC is introduced? Well, OK, now, given the fact that CBDC is lower cost to access, well, sure. Now, the threshold below which people are not going to hold deposit anymore is going to increase. So all this area here, oh, I keep on pointing to that. The threshold here before we had people before WA, they were not holding deposits. Now the threshold is going how? All these new people that have wealth within this region, they're not going to hold deposit anymore. Why? Because they're just going to switch to CBDC. On the other hand, all the people with wealth above WB now, well, now you know the banks, they're going to increase interest rates. And so they're actually going to hold more because it's more convenient for them to hold more deposits. And so this is actually what we were discussing before. When we talk about the very simple model, we were capturing all in this intensive margin. Given that you had a deposit account, well, higher interest rates give you an incentive to deposit more. But now, you also have the choice of opting out of deposits. Well, this gives the extensive margin. And the extensive margin is people saying, you know, I'm well served by CBDC, I don't care about the bank anymore. And so the whole interplay, once you start looking at this way, is understanding when the extensive margin is stronger than the intensive margin. Because they all work in the same direction. The intensive margin always tends to increase deposits. The extensive margin tends to decrease aggregate deposits because some people go out. OK, first, OK, and then they're going to hold some CBDC. This is the line. And you see that people in this part of the wealth distribution, they're going to hold significant amount of CBDC, while in this part of the distribution, when they also have deposit, they're going to hold lower amount of CBDC. Why? Because they're always losing the cost, the return. CBDC pays 0 here. So while deposit, at least they pay something. So going forward, so these are the results of the model once we calibrate and we simulate it, before CBDC and after CBDC. And we're going to look at some key metrics. So for instance, focusing for beginning only on the first column with no CBDC. So you see, when there is no CBDC, people here in general have 1% of their total wealth in cash, and around 15% of the total wealth in deposits. The interest rate on deposit is 2.25%, and I forgot to say before, we're setting the policy rate, the bond rate, at 3%. So when we set this, actually, we did this simulation first a couple of years ago, before the rise in policy rates, and it seems like, whoa, this is a huge number. Now it's actually low, but so the banks, they earn a spread of 75 basis points. So that's the power, the franchise power of banks, the monetary power such that they can earn this money by providing deposits. Then we have a number for bank profit, which is not, I mean, it's only relative in terms of understanding. Then financial inclusion is the people who have a bank account, in this case 80%, but we calibrated the model such that this was the number was going to go out. So once we introduce CBDC, well, the first thing to look is how much the interest on deposit, remuneration deposit increases. So banks react to it. It goes, remuneration on deposit increased by around 50 basis points. It's substantial. I mean, given the amount actually of increase in our deposits after the increase in policy rates, which has been almost non-existent, doesn't exist actually, at least on my bank account, this is something actually that is relevant. What happens? Well, people are going to actually hold less cash. They're going to hold CBDC, around 3.5% of their wealth, which is actually consistent, and we're surprised by a couple of other papers that were trying to estimate the effects, maybe even the paper by Jackie is going to present afterwards. I don't remember exactly, but this 3%, we found it also in some other papers that were trying to estimate the demand of CBDC, and we were very surprised to find the same numbers. But then aggregate deposits are going to decrease. And they're going to decrease because there's going to be a change in the intensive margin that, okay, some people are going to hold more, 1.7 percentage points. But then all the fractional people that move out, they're going to hold much less. And actually 6 percentage points of deposit are lost through this way. And so this gives a net effect of loss of deposit of 4.2%. So this is the extent of the disintermediation with the parameters that we have now. Okay, but then what else can we learn for this model? And we're going to study a couple of key parameters that are important here. The first one, the cost of accessing CBDC. The second one is the wealth distribution of the economy. Let's first, in the first column. So let's assume now that there are higher costs of CBDC with respect to before. Now, what's going to happen? Of course, a lot of the people, the extensive margin is going to have less bite. Why? Because all of the people that were going to switch to CBDC because it was cheaper than deposit, they have less some incentives to do so. The question is, how much of a stronger bite can the extensive margin have? And actually, we can even overturn the result of disintermediation and go back to intermediation to have higher aggregate deposit into the backend sector. If you look here, well, in this environment, well, these numbers were as before. Now, actually, the change in deposit is 0.1%. So here, these people, you also notice that banks, actually, they don't increase as much the interest on deposits. Once the threat of a CBDC is less strong because the cost of access is actually lower, well, banks they often react and say, well, I'm not going to increase interest rate as much, and people are going to stay with me anyway. And so they're optimally going to react to the design feature of CBDC. In this case, the value is such that we don't get disintermediation anymore. We get intermediation. Now, let me get also another key parameter for us, which is the wealth distribution. Now, before we had a wealth distribution was matched to the US, let's assume that now we have a poorer society. So we're going to increase the alpha parameter, the Pareto distribution, so we have more mass on the lower wealth. Well, this actually goes the other way around with respect to CBD, to fixed cost. It goes the other way around because now we have a higher share of poorer households, and banks, everything goes through banks here. Here, the interest rate on deposits is the key endogenous variable. No? The banks have a less incentive to aggressively hike. And so they're also going to hike less. Notice only that these numbers here, the column, they're not directly comparable with these ones because alpha is a parameter that defines the calibration of the economy. Once we change the alpha, the economy looks radically different. So the numbers cannot be the same by construction. Anyway, the important thing here to get is that whenever the change in deposit out, this intermediation is much stronger. There are poorer households, banks don't have any incentives to go after them. And actually, what we get from here, is it possible to go into the additional slides of parameter space? I don't know whether, if you click on the button there, perfect. So you see here, we have a chart with alpha parameter on the x-axis and the ratio of the cost of CBDC and deposit on the y-assets. Actually, for the area in blue, The references are very interesting, but for the area in blue, we have disintermediation in the model. For the rest of the parameter space, there's actually no disintermediation at all. So maybe disintermediation is not something that happens very often, or at least through the lens of this model. We can go back to the previous slide. OK, perfect. Thank you. So now, so this, at least, I mean, we started with a very, very Mickey Mouse model, and we are starting to enlarge it and so on. First, we enriched the household side. Now, let's enrich a little bit the bank side. Banks so far are just investing in bonds and getting deposits. So what can we do? Let's try to add lending and wholesale funding. And we're going to do it in a very reduced form. I mean, we're not going towards general equilibrium, or at least this is not going to be part of our paper. We hope to write it at some point, but we haven't done it yet. But it gives a little bit more flavor or the forces that I play. So now we're going to have banks, and instead of just investing in bonds, they're going to have lending opportunities. And the lending opportunity is going to have a return which is a little bit higher than the policy rate, but it has some concavity, so there is some risk there. But they also can get funding, wholesale funding. We can call it wholesale funding. We can call it central bank funding. For the purpose of the model, it's actually equivalent. And also here, the funding has some cost, and then some shape parameter, concave parameter. And now we can try to think, OK, within this model, with this new lending and funding opportunity with banks, what happens to lending once we introduce CBDC? So these are the results. As before, so this is with the old parameter. So we had the parameter where we already got disintermediation. So we expect to get disintermediation here. We see that banks always increase their lending and so on. We see that there's a change in deposit with 3.9 percentage points. However, the change in lending is very small. It's only 0.18% of the lending before there was in the economy before CBDC. So why the change is so small here? It's basically that the way we set it up, as long as there are profitable opportunities for banks, well, they want to have a sufficiently large balance sheet in order to have these investment opportunities. You know, they're making money on the spread there. Now, if wholesale funding is cheap, assume wholesale funding is cheap, then deposits do not matter for lending. They can always, whatever happens, CBDC is introduced. Okay, this is disintermediation. I can always go to wholesale funding if it's cheap, cover my balance sheet, the liability of my balance sheet, and have money for the loans. And so banks don't care about CBDC. If instead wholesale funding is very expensive, OK, fine, the banks are going to fight more aggressively for deposits. And so there's going to be even a higher incentives for banks to increase their interest rate. Now, mind, in all of this, I didn't highlight it a lot before. Banks' deposits are going to decrease by default. We are squeezing their margin. And we're not talking about this in the model, but it's clear. I mean, once we squeeze their margin, banks' deposits are going to decrease. But actually, the aggregate effect of lending, well, it seems that it's not that large, at least within the parameter space that we're looking for. So this actually goes very much in the line of what Sergio and Calif was saying before. Banks maybe are resilient. They've been in the business for centuries, some of them. And the payments function of deposit is only something that existed for the last 50 years or so. So maybe sometimes we don't give too much credit to banks and how much stronger they are. So this is the conclusion. We have built a simple model. It nests other papers in the literature because some papers have this intensive margin only. Thinking about David Andolfatto, it's mostly about the intensive margin. Some papers only have the extensive margin. And this one, we're trying to bring them together. And usually, the one that looks at one of the other, they give opposite conclusion about this intermediation. That's why we thought about doing this. So our nuanced message is that, well, maybe this intermediation is not that large. And actually what we like is that we're putting the economic structure of the country is important. It's especially relevant for us that work at the IMF whenever we need to talk about CBDC, because like we need to look at different countries, and different countries have different economic structure. So for us, it's very important this. Of course, probably the discussant, I'm preempting the discussant here. This is a static model. We are not capturing any sort of dynamic effect on profitability or lower profitability of lending. Maybe our view of liquid assets is simplistic. We should model it more. Maybe it's a two-sided market, and so there are externality and externality in this that reinforce, amplify, or damp the effects. True, all well taken, but I think for us, I mean, the point for us was to build a very simple model to toy with this idea of disintermediation. And then maybe we should add more complexity here, maybe welfare analysis. This is something that we've been thinking in order to add to the paper. Thanks a lot.
Good afternoon, everyone. My name is Xiaoying. Thank you very much for inviting me to this great conference. I came from Indiana University, and I really appreciate to have this opportunity to discuss this exciting paper. I'm also doing research in central bank digital currency and its impact on the financial intermediation of the commercial banks. So I'm really enjoying reading this paper, and I think the author did a fantastic job putting together very important factors in a standard yet very elegant model in a way that help us to better understand this very important question, that is how CBDC will affect the bank intermediation. So having said that, I think we agree that the CBDCs still remain in a very earlier stage of development. Therefore, there are a lot of unanswered questions whether or not it will cloud in or cloud out bank deposits, depending on a lot of important factors. So for example, there are papers by the Train Devani Nishihiri and Jen and Drew published in the JBE. They said that bank market power or the competitiveness of the banking deposit market sector is an important factor determining whether the CBDC will cloud in or cloud out the bank deposits. So this paper, they highlight different perspectives. Specifically, they present two contrasting or opposing important factors, which namely is the intensive margin and extensive margin. So I think the author already did a great job explaining in detail what the intensive margin means and extensive margin means. So here I will just give a very intuitive, economic intuitive issues into these different two margins. So specifically, if we observe the intensive margin dominate the extensive margin under specific parameter specifications, then the CBDC actually will cloud in the bank deposits, meaning that bank deposits will increase. However, if it's opposite, means that if we have the extensive margin dominate, then the CBDC actually will cloud out the bank deposits. So the key parameters here in the extensive margin, which is also relevant to my discussions later, is about the access to the different liquid assets. So here, the liquid assets include like cash, CBDC, or specifically the bank deposits. So we assume that those relative costs of holding those liquid assets, people are trade off those costs with those benefits. For example, CBDC could provide different relative liquidity services compared to bank deposits. So households are trade off between those costs and benefits. However, if under this specific assumption that the cost of CBDC is way much less than the cost of bank deposits, like they show that it's costly for us to maintain a bank account, or it costs us for access the bank account. And also, if we have very unequal wealth distribution, meaning that the mass of the poor household is large, and also the bank don't have incentives to further increase the interest rate in order to maintain those households from living. That is because those poor households only own a very small fraction of the total wealth level. So it is not profitable for the banks to increase rates. So in this extensive margin, then under this two overall effect would be the CBDC will crowd out bank deposits. Okay, so the main overall takeaway, that is end of my introduction or summary of the paper, is that I think this is a very interesting paper on a first order important question. And also we haven't yet have a complete decisive answers to this question yet, and I think we will look forward to see more empirical work, and this is what my discussion will be. So I will take as an empiricist standard point of view and provide some of the empirical evidence, and I also will discuss some of the assumptions in a real-world setting using observational data. Okay, so my first comment is related to the choices of the key parameters, that is the cost of access in the CBDC. So the first question, or maybe suggestion, that I think in China, when the PBC, the Central Bank of China, when they introduced the CBDC, they designed in a way that the cost of access in the CBDC is kind of correlated with the liquidity services provided by the CBDC itself. So there are 4 types of CBDC people can obtain or access to in China. They can open 4 types of different wallet. There are 4 columns, at least here, type 1, type 2, type 3, and type 4. So if I would have your attention focus on the rightmost column, which is type 4. So this one is the lowest cost in terms of access to this wallet. It only requires people to have a mobile number, then they can open this wallet. However, this is the most stringent type of CBDC people can hold, in the sense that if you look at the restrictions or the threshold put in this type of wallet, if you focus on the 4th row, which is a single transaction people can do in this type of wallet, it's only 2,000 Chinese yuan. So the exchange rate from US dollar is 7 to 1, so meaning that people can only transact each transaction, which is $300. So I will take an example. For me, I feel it's out of allowing. For example, I want to pay my monthly fee. I believe in Washington, D.C., it will be, for example, like $2,000 per month. Then if you want to use this type of lowest cost of wallet, then you have to split, like do the transaction multiple times. And I feel this is allowing for me. So in terms of liquidity or the efficiency of the means of payment, which can be provided by this type of wallet, I feel like it's less compared to different types of CBDC. So if we look at the type 1, that one is unlimited, meaning that people can put whatever they want in those total balances, and also they can transact either single transaction, there's no limit, and daily transaction, there's no limit, and annual transaction, there's no limit. So my takeaway from this table is that I think the parameters proxy for the cost of access CBDC, which is the phi C in the model, and the parameters covering the liquidity services, which is delta C. So I think those 2 parameters are entering into the utility function of the households in a way that is separately additive in the equation 31 in the paper. So my question is that maybe we might be thinking about a way like model these 2 parameters as a functional form of each other, because at least from the Chinese market, we see they are kind of correlated with each other. Okay, so that is my first observation using the Chinese data, and later on, I think we already have this question from previous Q&A section that we know in China and, for example, Nigeria, the adoption rate or like the actually transaction rate people are already know in terms of the CBDC compared to other payment systems. So here I use the daily app activity data for eCNY and also the app for the mobile bank, which is how people conduct electronic transaction using the bank deposit, like their checking account. We see that over each month for the 2022, the mobile banking app usage activity data is average 10 times larger than the eCNY, which is the Chinese CBDC. And also, the gap is still enlarged if we compare CBDC with the largest third-party payments in China, which is the Alipay. So it's over the same time period, it's almost 1 times larger people using the RDPay instead of using the ECNY. So my question would be like, in the model, I think the utility assumption is that the utility services of the ECNY is larger than the other payment systems, especially for the bank deposits. So my question would be, this may not be the only dimensions when we are compare the relative benefits of CBDC can offer in terms of liquidity services compared to the bank deposits. So what other dimensions we might be looking at? That is also a question mark, and which is relevant to my job market paper, but I don't want to spend time on that. so this is just to give you a preliminary empirical evidence using a detailed transaction data from one of the Chinese commercial bank, which I have access to. So here I classify depositor accounts. I can observe the or granular transaction data from each depositor's accounts, both their transaction account, demand deposits, and also time deposits. So I classify 2 types of depositors according to the paper, that is lower income households and higher income households. So I assume that those people put a lot of money in the bank would be those higher richer people. They have a lot of money to save in the bank in terms of both those checking accounts and time accounts. So I use that as a kind of DID, difference in difference setup. The post dummy is here equal to 1. It is post the introduction of the CBDC. So if we look at the coefficient is significantly, statistically significant and meaningfully in magnitude, so it's negative, meaning that yes, according consistent with the results of the extensive margin in the paper, the lower income people decrease their holdings of bank deposits relative to those higher income peoples. Then the question is, why is this the case, given that people are not using CBDC? So I think this is a question like for me and also for those scholars in the audience, we need to think about what is those dimensions people are value CBDC, especially for those lower income people compared to rich people. Otherwise, why they are decrease their deposit holdings relative to the other group of the households. Okay, so that's pretty much the end of my discussion, but I'm happy to discuss about these mechanisms, which in my mind, in my paper, is like, I feel like one hypothesis could be like those lower income people, they are not only heterogeneous in terms of their initial wealth, they are also heterogeneous because, for example, their risk-averse preference is different. For example, I believe there is a wave following the Silicon Valley bankruptcy episode. They find out those people, even though we have the federal insurance, FDIC, the insurance coverage, those people with a lower degree, they don't have college degree, and also the lower income people, that especially worrying about the riskiness of the small bank. So in that way, if the CBDC could offer them a lower cost, a way of flight to safety, then that could make them to feel the small bank are safer or riskier in terms of their riskless habitat. So that is just my hypothesis, and that is the end of my discussion. I'm looking forward for future works on this exciting topic, that is how CBDC affect bank intermediation. So thank you very much.
So in the interest of time, to keep with the schedule, we might want to go to the second presenter, and then hopefully we use the break, Marcello, so that if people have Q&A, they could do that.
So thank you for having me here. Today I'll present the paper entitled Central Bank Digital Currency and Banking Choices. This is joint work with Andrew Usher from the Bank of Canada and Yu Zhu from Renmin University. So the usual disclaimer applies here. The views expressed in this paper and presentation are those of the authors, and they do not necessarily reflect those of the Bank of Canada or its governing council. Okay, so CBDC is here defined as a digital form of central bank issued money that is available to the general public and can be used for retail payments. Many central banks are considering the issuance of a CBDC. For example, based on a recent BIS survey, 90% of the central banks in a sample of 81 central banks are engaging in CBDC work. And more than 60% of the central banks are considering the issuance of a CBDC in the foreseeable future. Despite the widespread interest, there are concerns that CBDC can crowd out too many bank deposits, which can have financial stability implications. However, much less is known about the magnitude of the crowding out. And in this paper, we study to what extent CBDC could crowd out bank deposits. And different from Marcello's paper, we study this question using a more empirical approach. So more specifically, in this paper, we develop and estimate a structural model to study the impact of a CBDC on banks in the deposit market. So we want to answer questions such as how banks will respond to the competition from CBDC and how many deposits different banks will lose to CBDC. The key to answer these questions is to understand the differences between a CBDC and bank deposits. Apart from the interest rate that is often discussed in the literature, we incorporate two key attributes that can differ between a CBDC and bank deposits. So the first attribute is a service location. We know that banks provide an extensive network of branches where people can visit and get in-person services. But for CBDC, the central bank is not going to provide these client-facing services directly to the public. So where people can get access to these in-person services for CBDC becomes a practical design question for CBDC. So the kind of services we had in mind for CBDC could be the cash withdrawal from CBDC, or it could be onboarding services where you need to go to a service point in person to verify your identification, or it can be any technical help related to CBDC in case you forget the password to your account, things like that. So the second attribute is the complementarity across different financial products. We know that banks provide not only deposit accounts, but they also provide many other financial products such as mortgage loans and credit cards. This can generate complementarity across these products. And we do find in the data that people have strong preference for bundling different financial products at the same bank where they have their deposit accounts. So people do have this strong home bank preference. So accounting for this complementarity feature really gives banks a fair advantage over CBDC, because CBDC does not come with other complementary financial products, and people won't enjoy this complementarity feature from CBDC. So without accounting for this difference in complementarity, we can really overestimate the attractiveness or the adoption of CBDC. Okay, just to give you a brief overview of the methodology in this paper. So the objective of this paper is to study how a CBDC will compete with bank deposits. So the first thing we want to understand is how people make their decisions on which deposit bank they go to, so which bank they want to go to for their digital balance. And we want to understand what factors or what attributes are driving these decisions. Then, if we design CBDC along these dimensions of attributes, then we can then understand how households are going to choose between a CBDC or an existing bank. So our model consists of the households problem demand side. On the demand side, households will choose their deposit bank after considering things like the branch networks that a given bank would provide, and as well as the complementarity across different financial products. And on the supply side, each bank would provide a deposit product that is differentiated in terms of the deposit rate, in terms of branch network, as well as other attributes. And banks compete via arbitrage competition. They choose their deposit rates to maximize their profits. And then we estimate the model using household level and branch level data. So on the demand side, we can obtain the demand parameters, including household preference parameters for different attributes like the rate of return or the branch network. And on the supply side, we estimate banks' marginal costs, which are treated as supply side primitives, and it do not change after CBDC is issued. And then we use the estimated model to study counterfactual analysis on CBDC. So where CBDC is viewed as a new product with the attributes chosen exogenously by the central bank, and using the estimated preference parameters for the attributes together with the exogenous chosen attributes, we can then study the level of utility the households would enjoy from CBDC relative to the existing banks. So the existing works on CBDC are mostly theoretical because of the lack of data on CBDC. So most empirical works right now use the structural model approach. This paper is most closely related to my previous paper and Tony White's recent paper. So in my previous paper, I look at the potential demand for CBDC relative to cash and deposits, but I largely ignored the bank's endogenous responses to CBDC. And in the recent paper by Tony Whitehead and her co-authors, they used a structural model to study the impact of a CBDC on bank lending and bank disintermediation and bank stability, but using bank-level US data. But in this paper, we focus on the impact of a CBDC on the deposit market. But using the rich micro-level data, we're able to capture two important attributes that can be different from CBDC and deposits. So the branch network, as well as the complementarity. Okay, so I'll talk about the model first, and then I'll talk about how we introduce CBDC into the model. Then I'll talk about the data and some estimation results, and finally I'll move to the counterfactual analysis and conclusions. Okay, so our model consists of the household's problem on the demand side and bank's problem on the supply side. So I'll first talk about the household's problem. So each household first chooses which bank to go to for their deposits. And then they allocate their liquid assets between cash and deposits. And then later on, they may need to take out a mortgage, or they may need to get a credit card, in which case they decide which bank to go to for that financial product. So we solve this model using backward induction. So talk about the last stage first. So in the case when the household needs to get another financial product, it could be mortgage loan or it could be a credit card, then the household will need to decide which bank to go to for this financial product. And this bank N doesn't have to be their deposit bank, but they will enjoy some extra utility if they take out a mortgage or get a credit card from the same bank where they have the deposit account, because they have this home bank preference. So using the parameters from this stage, we can obtain the expected utility from getting this financial product K. So because this expected utility depends on the choice of the deposit bank, J, so when the household first chooses their deposit bank, they will need to consider this expected utility from getting the other financial products because of the home bank preference. And then the second stage is a portfolio allocation. This is another consideration for the deposit bank choice. So each household is endowed with some liquid asset balance. And the household will want to hold it in both the physical form, which is cash, and the digital form, which is deposits. And so conditional on the choice of the deposit bank, the household allocates their endowed liquid assets between cash and deposits optimally. And they enjoy some utility from holding this portfolio of liquid assets in cash and deposits. So different banks will provide them with different utilities from this liquidity holding, because banks can give them different deposit rates, for example. So when they first choose their deposit bank, they will need to consider this utility from liquidity holding. So back to the first stage where the household needs to choose a deposit bank J. So the household choose one bank out of a choice out of different banks. So they will compare the utilities they obtain from different banks. And the utility for each bank J would depend on the branch network of Bank J, as well as the utilities from liquidity holding and the expected utilities from having other financial products later on. Okay, so from the household's problem, we can get each household's expected deposit demand. And we aggregate over each household's deposit demand to get the deposit demand at the bank level, to get each Bank J's deposit demand, which depends on the Bank J's deposit rate, but as well as all the other banks' deposit rates. So Bank J would take other banks' deposit rates as given, and Bank J sets its own deposit rate to maximize the profit. So RJL here is the exogenous return on loans, and MC here is the bank's marginal cost. So because we focus on the impact of a CBDC on the deposit market, here we try to make the loan market as simple as possible. We have the exogenous return on loans here. So from the first order conditions, we can obtain the equilibrium deposit rates. So on the on the left-hand side is the bank's markup, and on the right-hand side is the inverse semi-elasticity of the deposit demand. So after CBDC is issued, we treat the loan rate, the loan return, and the bank's marginal cost as supply-side primitives, and they do not change after the issuance of the CBDC. But the CBDC introduction will change the deposit demand elasticity on the right-hand side. So then the banks would optimally adjust their deposit rate in response to the competition from CBDC. Okay, so after we introduce CBDC into the model, it's like we're adding a new alternative to each household's choice set. So here it's just for illustration purpose, say the household had J banks in its choice set, but now with CBDC, CBDC is just an extra choice alternative for them. So now with CBDC, the household can choose either to deposit their digital balance in CBDC or go to one of the existing banks for their digital balance. And introducing CBDC will reduce the probabilities of choosing the existing banks. And depending on how attractive CBDC is, the impact of CBDC on banks could be different. So if CBDC is designed to be more attractive, then the impact on banks will be larger. So in this presentation, I'll just focus on the following CBDC design choices. So we look at the CBDC interest rate, the complementarity feature, as well as the network of service locations. So for CBDC interest rate, once a household chooses CBDC, in our model, they will then allocate their liquid assets between cash and CBDC. So the CBDC interest rate will affect their utility from holding this portfolio of liquid assets in cash and CBDC. It will affect their allocation between cash and CBDC. And so here we take the stance that CBDC does not come with other complementary financial products, so it's a fixed design choice that there's no complementarity with other financial products for CBDC. So that means the expected utility from getting other financial products would be lower compared to banks, because if CBDC is your home bank, you would never enjoy this complementarity. You still need to go to another bank for the mortgage loan or credit card. So the expected utility when CBDC is your home bank would be lower. And then we look at different designs for service locations for CBDC. Okay, so we mainly use the Canadian Financial Monitor household survey data that contains information on households' banking choices, as well as their residential location and other characteristics. So I want to point out here that a unique feature of this data is that we do see households' banking choices for different financial products. So we see if they go to Bank A for deposit account and if they go to Bank B for mortgage loan, etc. So this really allows us to estimate their home bank preference. So if we see they choose TD Bank for deposit account, we can see if they're more likely, we can estimate if they're more likely to choose TD Bank for other financial products. And then we combine households' residential location data with the bank branch location data to measure the branch network that is specific to each household's local area. So we can really measure the distance from the household's residential location to the bank branch. And then we use the Canada Post Office location data for one counterfactual scenario where we look at the case when the post office locations can be used as service locations for CBDC. And then we have the bank level interest rates from Mechanics that has the demand deposit rates for the big 6 banks and the 5-year closed mortgage rates, which are used to measure the exogenous return on loans. So this is the most popular mortgage product in Canada. Okay, so in the following 2 slides, I want to quickly summarize the estimation results. So from the demand estimation, we estimate the demand parameters in 3 steps. So we first estimate their banking choices for other financial products, and we look at 3 different financial products. We look at mortgage loan, credit card, and guaranteed investment certificate, which is a term deposit product in Canada. And so from this estimation, we see that people have strong preference for getting a financial product from their home bank, from the bank where they have deposit accounts. And using the parameters from this stage, we can obtain the expected utility from getting a particular financial product K, which we then plug into the deposit bank choice estimation. And then in the second step, we estimate the portfolio allocation problem, and we find that when the deposit rate increases, the holdings of deposits would increase relative to cash, which is as expected. And using these parameters, we obtain the utility from liquidity holding from this stage. So another thing I want to point out is that for this home bank preference, the results are not really surprising because we find that 56% of the mortgage borrowers, they tend to just take out the mortgage from the same bank where they have their deposit accounts. And similar statistics hold for other products like credit cards and GIC. And then back to the deposit bank choice, we plugged these 2 utility terms into the deposit bank choice estimation. And we find that, of course, branch networks matter and people have strong preference. People do value the branch networks, but they also value the utilities from liquidity holding and the utilities from getting other financial products. Okay, so on the supply side, we obtain banks' marginal costs using the estimated demand and banks' first order conditions. So in 2017, when the counterfactual CBDC would be introduced, on average, banks would have a 5-year closed mortgage rates of around 4.8%, and the observed deposit rate in the data is around 0.1%, and the estimated markup using the demand parameters is around 2%. So that gives us an average bank's marginal cost of around 2.7%. So we treat these banks' marginal costs as supply-side primitives that will stay unchanged after CBDC issuance. And similarly, we treat the preference parameters from the demand side as model primitives, and they don't change after CBDC issuance. And then we solve the Nash-Bertrand game for each CBDC design. So in the following slides, I will talk about different counterfactual analysis, but I will focus on the following CBDC design choices. So the CBDC interest rate, CBDC branch network, in which case we look at different design scenarios where there is no service location for CBDC, or all the Canada Post offices are used as service locations, or when all the bank branches are used as service locations for CBDC. And we take it as a fixed design choice that CBDC does not have the complementarity with other financial products, and this gives banks a fair advantage over CBDC. Okay. So in this slide, I plot the aggregate CBDC shares under 4 different designs of service locations and 2 different designs of CBDC interest rates. So on the y-axis is the aggregate CBDC share, and it's calculated using the total CBDC holdings divided by the total household liquid assets. And if you see the first 2 bars, when there's no service location, the CBDC share is very low. It's just below 1%. And if all Canada post offices are used as service locations, even if CBDC is non-interest bearing, the aggregate CBDC share increases to around 6%. And then when all bank branches are used as service locations, the share increases to more than 8%. And then when all the bank branches and Canada Post offices are used as service locations, the CBDC share can be more than 10%. And so when the interest rate increases to 0.1%, the CBDC share increases slightly. But this is not to say that interest rate is not important, because I use 0.1% because it is the average deposit rate in the year 2017 when the counterfactual CBDC was introduced. But say if the interest rate is 1.5%, then within each service location design, the CBDC share would double. So if the interest rate is attractive enough, then it can still have a large impact. So here I plot the percentage change in deposits, again, against 4 different designs of service locations and 2 different designs of CBDC interest rates. So here, the percentage change in deposits they're averaged across different banks. So when CBDC has no service location, the impact on crowding out deposits is very small. But say if all bank branches and post offices are used as service locations, the crowding out effect on deposits can be larger. And another thing I want to point out here is that here we're assuming that CBDC does not have the complementarity feature. But say if we don't account for the complementarity features such that both bank deposits and CBDC do not have this complementarity feature, then the crowding out effects on deposits can be much larger, because in that case, CBDC is the relative attractiveness of CBDC increases, and the adoption of CBDC will be higher. Okay, so in this slide, I showed the bank's heterogeneous responses to CBDC. So here I showed the change in deposit rate in basis points against the bank's initial market share. So each point corresponds to 1 bank. And so here there are 4 different designs for service locations, and CBDC is assumed to be non-interest bearing here. So if you look at the pink triangles, you can see that when banks they have higher initial market shares before CBDC issuance, these banks also tend to be the ones that respond more to CBDC by raising their deposit rates by more. So these banks tend to have higher markups, so they respond more in rates, and it turns out that they would also lose fewer deposits. So intuitively, this is because in a world without CBDC, the smaller banks, they're already dominated by the large banks. So it's really the large banks that will be threatened more by the CBDC. So after CBDC is issued, the smaller banks will not respond as hard relative to the big banks. Okay, so I also want to discuss one interesting counterfactual that we study, which is the limits on CBDC holdings. So many jurisdictions are considering the limits on the holding of CBDC to reduce the crowding out effects and to manage the financial stability risk. So for example, the Bank of England is discussing a limit around £10,000 to £20,000, and ECB is discussing a limit of around 3,000 to 4,000 euros. So in our model, we can study these the impact of the holding limits because we embed this portfolio allocation problem into the bank choice problem. So in our model, if a household chooses CBDC, they would allocate their liquid assets between cash and CBDC. And say if a household is constrained by this limit on CBDC, then this household would just hold the constrained amount of CBDC and then hold the rest in cash. But then because of this suboptimal allocation, they would obtain a lower utility from liquidity holding, and this reduces their probability of choosing CBDC in the first place. So the constrained households would be less likely to choose CBDC. Okay, so in this slide, we show the effects of the CBDC limits on aggregate CBDC shares. So we plot the aggregate CBDC shares against different designs of the CBDC holding limits. So for the no limit case, the results are identical to the results I've shown before. But you can see that when the CBDC holding limit is large, it's 25,000 Canadian dollars. Still, the impact of the CBDC limit still has a large impact on reducing the aggregate CBDC share. So this is an interesting result, we think, because in this case, so say if the holding limit is 25,000 Canadian dollars, only a few households will be constrained by this limit. So around 13% of households are constrained in this case. But still, this limit has a large impact because those households tend to hold the majority of the total liquid assets. So that explains why. Okay. So finally, I want to use this slide to remind people that although we've talked a lot about the crowding out effects of CBDC, but introducing CBDC can benefit some consumers, at least depositors. So here we show the change in consumer surplus for different CBDC holding limits. And so depositors would benefit from the introduction of CBDC through a more competitive deposit rate and a potentially better product. Okay. So just to conclude, we develop and estimate a structural model to quantify the impacts of a CBDC on banks' deposits, incorporating some key features like the interest rate and complementarity between CBDC and other financial products, as well as a branch network for in-person services for CBDC. So we find that a non-interest-bearing CBDC that does not come with complementary financial products, it can still have a substantial impact on bank deposits. For example, if every bank branch is used as a service location for CBDC, then it can crowd out bank deposits by around 10% on average across banks. And if CBDC has no service location, then its impact is very small. But if we introduce a holding limit on CBDC, even if the holding limit is very large, it can still substantially limit the take-up of CBDC. Okay, that's all what I want to say. Thank you for the opportunity to present this work.
So I'm Hector Perez from the IMF. Thank you very much for inviting me to discuss this nice paper. It's an honor to be in front of this distinguished audience. And we are live here on TV, so I better not forget that these are all my own views, and they don't represent the views of the IMF executive board or management. And I am particularly happy to discuss this paper. I used to be in the Bank of Canada. Actually, Andrew used to be my RA a long time ago, and he came back to the bank with a PhD, and I'm glad to see that he's doing high-quality research. So this paper, there are many things I like about this paper. It's simply, don't get distracted by the apparatus. It's very sophisticated, the structural model, but at the end of the day, what we do here is to estimate the effect on CBDC on bank market structure. There are two main channels here. The first channel, CBDC, is just like having a digital deposit. So CBDC, presumably, the central bank is not going to offer mortgages or personal loans. So CBDC does not offer complementary financial products, which is bad, because people like that. When you bank with a commercial bank, you want to have the whole package. You want to have deposits, mortgages, loans. On the other hand, the branch network of CBDC can potentially be very large, because you could, say, force or ask the banks to offer CBDC in the commercial bank branches, or use other services like Canada Post, which has a broad network, to offer CBDC. So the network could be potentially very high. We know people value networks, be close to a branch network, to a branch bank branch. So this is positive for CBDC adoption. So what the authors, what they do is to propose a sophisticated structural model that provides reasonable and intuitive counterfactual estimates. To me, the numbers, they look reasonable. I believe them. And this is the best you can do empirically, because we know, well, there are many pilots, but actually actual countries that are offering CBDC are four countries, Nigeria, Jamaica, Bahamas, and this small island community in the Caribbean. We don't have data. Adoption has been very limited so far. So empirically, this is the best you can do, to construct a nice, sophisticated structural model and then do the counterfactual. And this paper nicely, therefore, contributes to the CBDC literature. So actually, this is a nice session, because the previous paper provides like a very nice insights to it's closely related, and also nicely contributes to the banking structural IO literature. So moving forward, the methodology very quickly, you have a set of primitives, demand and supply primitives, the households, they value proximity to branches, and complementarity of financial products. So that's what is embedded in the demand function. Then the banks, they compete for deposits, setting rates. They compete at arbitrage. And all those, as simple as that, those mechanisms are in the model. CBDC, what happens is would be a new competitor. So after the authors estimate these primitives, CBDC is a new competitor, a new potential entrant in the market for deposits. And then the authors can do this counterfactual exercise. What would happen if you have this extra new competitor, with potentially a very large network? They resolve for the equilibrium and they provide the estimates. Now, without network, let's assume CBDC doesn't have any network. Why would you choose CBDC? You don't really have a reason why, because CBDC doesn't offer mortgages, nothing. It's just digital deposit without any branches. So indeed, without a network, CBDC in this model is not attractive, and the market share is basically zero. If it is not exactly zero, it's because there is some randomness, in the model. With a large network, CBDC, according to the estimates, could reach about 11.6% of the market share. So this is business stealing, right? You are getting part of the pie because it's a new competitor and the competitors are competing, competition is harder. And deposit rates would increase by between 20 and 40% because of this effect. So this is what this paper is about. And I'm going to provide some constructive comments for consideration of the authors. So my first comment. So it's about this channel that everybody is talking about, and I don't know if you should just mention it in the paper, or perhaps you could even try to model it, or maybe it could be a different paper. But actually, everybody talks about CBDC being a safer asset. It's provided by the central bank. So in that case, CBDC is potentially more attractive than commercial bank deposits because banks are vulnerable. Now, here is the case of Canada. Maybe that's why the authors didn't consider this case. Canada is incredibly an very incredibly safe financial system. No major banking crisis in 100 years. I know that I lived there for 7 years. So, and also there is deposit insurance. So maybe in Canada it's not relevant. But what about other countries, right? And coming from the IMF, we have a very broad membership, 190 members, if I'm not mistaken. There are many countries out there, many banking systems that are very vulnerable. The banks can be very, not diversified at all. Small banks, highly fragmented banking system. They can be very sensitive to competition and profit losses because of competition. So this is a mechanism that is very likely out there, and at the very minimum, you should mention it. Indeed, during the economic crisis, financial crisis, there is a flight to safety. CBDC would be a safe asset. Many people would like to put their deposits in CBDC rather than staying with these vulnerable commercial banks. So this is something worth at least mention. Yes, there is deposit insurance, but it's limited. And the large deposits, there are limits to deposit insurance. So the large depositors are going to be affected, even in Canada too, right? So try to discuss it, that would be nice. Or even could be, maybe I'll give you ideas for a new paper. My second comment, it's on how banks can react to CBDC. Here, banks, the assumption is they compete more fiercely, setting higher rates because there is a new competitor. But the banks could also compete in the product space that is not modeled here. And it is not modeled, I understand, for tractability too. It would be extremely hard probably to model simultaneously this per trunk competition in the deposit space and then another, also competition in the asset in the product space. So it would be very hard. I understand. Maybe you can do it. I don't know. But what I would say is that the banks, they could react to CBDC by competing, offering lower rates in mortgages, maybe bundling products. Say, hey, you come with us. We offer you a credit card plus a deposit, a special price, no fees, and so on. So this would be the natural reaction of commercial banks to compete also in that space. Also, well, this is very related to the previous paper. I mean, the mechanism is purely business stealing effect here. CBDC rates push competitors' rates, right? Rates increase, but bank deposits decrease. I would like to know what happens in total when CBDC deposits plus commercial bank deposits. Do they increase? Do they decrease? The previous paper was very nice because it was talking about the intensive margin effect, extensive margin effect. There are cases where total deposits increase, total deposits may decrease. So it would be nice to see what happens. By total deposit, I mean CBDC plus bank deposits, right? So to see what happens. Because everybody's talking about CBDC and monetary policy. I mean, CBDC enters, rates are higher, perhaps. Total deposits are going to decrease, people save more, so that affects monetary policy. So at the very least, mention these implications for monetary policy, what would happen. That would be nice. At the end of the day, I'm talking about extending the policy relevance of the paper. Very nice paper, carefully done, the best you can do empirically out there. So try to kind of extend the policy relevance of the paper. And then my almost previous to the last comment. And this one is maybe a bit, less esoteric, but, there are digital illiteracy, right? Barriers to adoption. There is a reason why CBDC, sorry to put it bluntly, but has been very, kind of a failure in all these countries that have adopted it. Very limited adoption. There are many barriers. People, there are barriers to, these digital products. So the paper shows that in rural markets, precisely because the branch network is limited, that's where the effect of CBDC is larger, because there are no branch networks, but then you have access to all these US postal branches. So, but precisely in those markets, perhaps people, they have higher barriers to use digital products, sophisticated like CBDC. So you should perhaps this incorporate it in the model, somehow kind of take into account these barriers to digital money adoption for a specific type of users. You already use demographic variables, but they are assumed to react the same way, I guess, no? But CBDC is a new product, right? And it's very sophisticated, and people have problems to use it. Old people, for example. So that's something that you could do. And my second comment, well, it's true. There are no, the central bank is not going to start selling mortgages to the people. We know that, probably, right? But what about all this ecosystem, like DeFi? Because CBDC opens the door for programmability and new apps and new services linked to this new digital ecosystem that is going to arise. So on the one hand, there are no mortgages, but you have, you could use CBDC with other products. So worth mentioning this in the paper. So finally, and as I said, coming from the IMF, we have a very broad membership. We care about the countries, and we have talked a lot with these countries discussing the cases. We have a handbook now and many meetings to see what happened in Nigeria, Jamaica, Bahamas, and the ECCB, the Eastern Caribbean Community. Very limited adoption in these countries so far. I think it would be also, again, to extend the policy relevance of this paper to see if you can apply. There are lessons we can learn to apply to other countries, not only restricted to the very specific Canadian case, very unique. And in these countries, I mean, CBDC is likely to be, very useful in low-income and emerging economies because precisely the low financial inclusion and low banked population. So, but in these countries, precisely is where you have more unstable, fragmented banking systems, where the safe asset channel that I mentioned before is probably going to be more relevant. So, in general, try to see if you can test your prediction in these countries, or if you can, these lessons for Canada can be extrapolated. So, I'd like to finish here. Again, thank you very much for inviting me. I enjoyed a lot. Very nice paper, contribution to the literature. I think will be published in a very nice journal, hopefully. Highly detailed, empirically sophisticated, the best you can do empirically because there is no data out there. So that's the only really, econometrically have a sophisticated model and prepare counterfactors. I provide some comments to try to expand the policy relevance of the paper. And again, thank you very much, and I hope you enjoyed it and it's useful for you. Thank you.
We have time for maybe one question.
Sure, for one question. But I guess I had a question, which is, how should we think about the branches in this estimation? Because a lot of the talk about CBDC is about e-commerce, online transactions. What does it mean that we need branches? Because I would then worry that maybe the branches here are proxying for a little bit of this complementarity, right? I want to have a bank that has branches nearby because branches are useful to talk about wealth management, they're useful to talk about mortgages, and so then in some sense, the idea of putting on the branch utility benefit seems to overstate the space of possibilities for CBDC in that way. I guess I'd be curious how the authors would think about that.
Do I still have 30 seconds? Thank you for the question. Yes, so although deposits are digital as well, right? So, but in the data, we do find supporting evidence that people still value the branch networks. And we do see for what purposes they visit the branches for. So we see that for certain service categories like customer service and support or applying for a new product, people still prefer branches over other methods like phone calls, online banking, or mobile banking, suggesting that there are certain services that people still value them to be in person, and these services would definitely matter for CBDC. Yeah, I don't know if that answers part of your question.
In essence, if the point is I want the branch to be able to apply for new products, but the base modeling assumption is that CBDC does not come with other products, then we should expect that the branches are not as important for CBDC in the same way that they are important for, a regular bank relationship.
But there will still be customer service and support. So
Sure,
yeah.
and I guess the question is then how much of the effect is a
Right.
customer service, like I need someone to talk to because my app isn't working, versus I like having someone to talk to because I might need other products that is driving the effect, right?
Yeah,
One
yeah, I
or
think
the
that's
other
a
may be
great
more or
point.
less
So maybe there's
extrapolatable.
also the trust component in it, the branches, the presence of branches would inspire trust and things like that. But we need to think more about it. Thank you.
All right, there's time to caffeinate more outside.